Hey everyone, welcome back to Corporate Decoder, where we dig through the documents so you don't have to. Today we're diving into Archrock's latest quarterly report. It's like peeking into a treasure chest filled with numbers, but sometimes that treasure is fool's gold. Speaking of treasure, a lot has changed with them. They did a whole lot of investing and business combining to boost the company. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more stock chat. Archrock, in short, is all about natural gas compression. They squeeze gas to move it around, providing services to energy companies across the US. Their recent report covers the first 3 months of 2025. Let's get straight to the numbers. They reported a net income of $70.85 million a year ago. That's like turning a small profit into a pretty sizable one. Their earnings per share also rose to 0.40 cents last year. Pretty good, right? These numbers give a quick snapshot that Archrock is doing better this year, but let's not take everything on face value without a further investigation. Archrock makes money through two main ways. The first is contract operations, where they're basically renting out and running compression equipment. And the second is aftermarket services, selling parts and repairs. Contract operations are their bread and butter, bringing in $300, $4 million and $4 million dollar, compared to 24 and around $4 million border compared to $23 and $43 businesses. So $46 BizDit dollars and $1,018 in dollars, just slightly up from last year. This is pretty normal since their equipment has high margins. It means that they are being used more and newer contracts are coming in. Of course, to make money, you have to spend money. Their costs also went up. Looking at what they call cost of sales, which is the direct cost of providing their services, it reached $112.7 million the previous year. That's mostly from running those contract operations. But their margins also went up 5% to 70%, which is really good. That's like selling something for $1 and getting 70 cents profit. It is not always what you make, but what you keep. There were some additional costs that affected their earnings before taxes, which ended up being $92 million, way up from $53.6 million general and administrative expenses, or SG&A for short, which increased a few million. They also had higher depreciation and interest expenses, or SG&A for short, which increased a few million. They also had higher depreciation and interest expenses due to those recent acquisitions. Switching gears, let's peek at their balance sheet, or what they own and owe. Cash is at $4.8 million, basically the same from last year. Their debts or liabilities are at $2 increased quite a bit from December. They are mostly bank and bond debt from borrowing to buy other companies, so they are taking on more debt. Speaking of debt, Archrock has a lot. Over $2.2 billion. This is pretty standard for a business that uses leverage to invest and expand the amount they own. And while this debt is in the long term, it must be watched since interest rates or demand for their services might fluctuate. A good way to see if a company is making money is to view the cash flow statement. For the first 3 months of 2025, their operations brought in $115.6 million, and investing sucked out $116, and doesn't only $4 million because they are investing heavily, and financing activities added $48.8 million. So overall, not too bad. It shows they are investing and using leverage to boost growth. Now let's talk about the deals they did. A big one was the TOPS acquisition, which included a fleet of approximately 580,000 horsepower. Basically, they bought a competitor to increase their market share and operation size. Another thing to note is the NGCS deal, which they just closed. Now comes the tricky part, figuring out what things are actually worth. They have a few investments like an ECODC and Ionoda, which they value using something called the fair value option. This means they estimate what these investments are worth in the current market. For Ecody, it was decided their shares were worth $14.7 million at values in unobservable data, which is pretty important in figuring out their fair value. One last topic, shareholder activity. They repurchased some shares and also issued new ones through employee plans. The dividend stayed consistent this quarter at same retained shareholder value. In 19 per share, buying back shares lets the business increase the stock price and retain shareholder value. One thing to always pay attention to is the risk factors, where the business shares what keeps them up at night. The report mentions everything from macroeconomic instability, cybersecurity risks, and other regulations. Of note, it mentions risks from integrating NGCS and the risks to their customers' financial condition, because if they go bankrupt, have liquidity issues, that would also be felt by Archrock. Overall, this quarter looks good for Archrock. Revenue and income are up, driven by their core contract operations, and their aftermarket services segment held its own. They were active on investing and acquisitions. The potential challenge may come to long-term debt and potential hiccups on any of their recently acquired businesses. This makes the company direction stable, assuming they can keep integrating company and paying down debt. As Archrock a stock to buy, it looks interesting, but with the high debt, you might have to see what happens next quarter with the debt levels and how their most recent acquisitions are being assimilated. What do you think about Archrock's quarter? Leave your comments below. Make sure to hit the like button and subscribe. And finally, make sure to join our community linked in the description below. See you in the next report.